Employment data is the bedrock of economic analysis. It's more than just numbers, it's a window into the financial well-being of a nation. Understanding employment data is crucial for investors, policymakers, and anyone trying to make sense of the economic landscape. When people have jobs, they spend money boosting economic activity. Conversely, high unemployment often signals economic distress. It indicates that businesses are hesitant to hire, potentially slowing down economic growth. Employment data, therefore, provides crucial insights into the direction of an economy. This data is especially critical for understanding the movement of crucial assets like gold and foreign exchange, or Forex. Gold, often seen as a safe haven asset, tends to be influenced by economic uncertainty. Forex, the exchange of different currencies, is heavily impacted by a country's economic performance, which employment data directly reflects. In essence, employment data acts as a vital sign for the economy, influencing investment decisions and policy changes. This essay delves into the specifics of how this data shapes the dynamics of gold and Forex markets. Understanding these relationships is paramount for navigating the complexities of the financial world. The unemployment rate is a key indicator of economic health. It represents the percentage of the labor force that is actively seeking employment but unable to find it. A high unemployment rate suggests a surplus of labor in the market. This often leads to lower wages as businesses have more candidates to choose from. Lower wages can dampen consumer spending, further impacting economic growth. For investors, a high unemployment rate often signals a period of economic uncertainty. This often drives them towards safe haven assets like gold, increasing its demand and price. Conversely, a low unemployment rate indicates a robust economy with more people earning and spending. This can lead to inflation as demand for goods and services increases. Central banks often respond to low unemployment and rising inflation by raising interest rates. Higher interest rates can make a currency more attractive to foreign investors, leading to its appreciation in the Forex market. Thus, even small changes in the unemployment rate can trigger significant shifts in gold and Forex markets, making it an essential data point for any investor. Wage growth, the rate at which salaries increase over time, is another crucial indicator within employment data. Rising wages mean consumers have more disposable income. This fuels economic growth as people spend more on goods and services. However, wage growth can also lead to inflation. If wages rise faster than productivity, businesses may increase prices to maintain profitability. This can erode purchasing power and impact consumer confidence. For the gold market, the relationship with wage growth is complex. On the one hand, rising wages can boost economic optimism, potentially reducing the demand for safe haven assets like gold. On the other hand, if wage growth is perceived as a driver of inflation, it can push investors towards gold as a hedge against eroding purchasing power. Forex markets closely watch wage growth as a barometer of inflationary pressures. High wage growth can lead to central bank intervention through interest rate hikes. This can attract foreign investment, strengthening the local currency. Understanding the nuances of wage growth is therefore critical for navigating both gold and Forex markets. Gold, a tangible asset with inherent value, has long been considered a safe haven during economic turbulence. When unemployment rises and markets become volatile, investors often flock to gold. This is because gold is perceived as a store of value that retains its worth even when other assets decline. The inverse relationship between gold prices and economic stability is well documented. When unemployment rises, signaling economic weakness, gold prices tend to increase. This is because investors, fearing a decline in their other investments, seek the security of gold. Conversely, when unemployment falls and the economy strengthens, gold prices often decline. This is because investors feel more confident in the market and shift their investments towards assets with higher growth potential. Understanding this dynamic is crucial for investors seeking to diversify their portfolios. Gold can act as a hedge against economic uncertainty, but its price can also be influenced by factors beyond employment data. Section 5. Forex front. Employment's sway on currencies. The Forex market, where currencies are traded, is particularly sensitive to employment data. This is because employment numbers provide a snapshot of a country's economic health, a key factor influencing currency valuations. Strong employment figures often signal a healthy economy, making its currency more attractive to foreign investors. This increased demand can lead to currency appreciation. Conversely, weak employment data can trigger currency depreciation as investors lose confidence in the economy's prospects. Central banks play a crucial role in this dynamic. They use interest rates to manage inflation and stabilize currencies. Strong employment data may prompt central banks to raise interest rates to curb inflation, further bolstering the currency's value. Understanding the interplay between employment data, central bank policies, and Forex markets is essential for navigating this complex landscape. By closely monitoring employment announcements, traders can anticipate potential currency fluctuations and adjust their strategies accordingly. Section 6. Illustrations from the trenches, real-world market reactions. The impact of employment data on gold and Forex markets is not merely theoretical. It plays out in real-time market movements. For example, in 2008, during the global financial crisis, the U.S. unemployment rate surged, reaching 10%. This period of economic uncertainty triggered a flight to safety, with investors pouring into gold. As a result, gold prices soared, reaching record highs. Conversely, in 2019, when the U.S. unemployment rate hit a 50-year low, gold prices remained relatively stable. This indicated that investors were confident in the economy's strength and saw less need for safe haven assets. In the Forex market, the release of U.S. non-farm payroll data, a key employment indicator, often triggers significant volatility. A positive surprise, with job creation exceeding expectations, typically strengthens the U.S. dollar. Conversely, a disappointing report can lead to a sell-off of the dollar. These real-world examples highlight the tangible and often immediate impact of employment data on market dynamics. Section 7. Traders' Playbook: Adapting Strategies to Employment Data. For traders, understanding how to interpret and react to employment data is paramount. This data can be incorporated into trading strategies in several ways. Firstly, it's crucial to closely monitor the release schedule of key employment indicators. These releases often trigger significant market volatility, creating trading opportunities. Secondly, understanding the relationship between employment data and market expectations is key. A surprise, positive, or negative report, deviating from market consensus, tends to have a more pronounced impact on market movements. Thirdly, traders can use employment data to confirm or challenge their existing market outlook. For example, if a trader anticipates economic growth but employment data consistently disappoints, it might be prudent to reevaluate their position. Incorporating employment data into trading strategies requires careful analysis, risk management, and an understanding of broader economic trends. Section 8. Conclusion: Navigating markets through the lens of employment. In conclusion, employment data plays a pivotal role in shaping the dynamics of gold and Forex markets. Unemployment rates and wage growth, as key indicators of economic health, directly influence investor sentiment, central bank policies, and ultimately, asset prices. Understanding these intricate relationships is essential for investors and policymakers alike. For investors, closely monitoring employment data provides valuable insights for making informed investment decisions, managing risk, and potentially capitalizing on market movements. Policymakers rely on employment data to gauge the effectiveness of economic policies and make adjustments as needed. In an increasingly interconnected global economy, understanding the language of employment data is no longer optional. It is a prerequisite for navigating the complexities of the financial world.